I'm so glad you decided to join us today. I'm excited to be able to help enlighten you a little bit about all this crazy stuff, part of the new Section 199A. We're specifically today going to be covering what a specified service, trade, or business is. I know there's a lot of confusion in this in our industry. We're going to talk about qualified business, and this is going to just help make this a bit easier. A quick little bit about me is I've been doing this for, you could say, a few years. I'm an enrolled agent, and I don't want to spend all the time talking about me. If you're interested, you can check that out in the slides. But really, the reason you're here is you're interested in what exactly is a qualified business or a specified service, trade, or business. So our whole topic today, we're going to be touching on the background of how this came about, but then we're going to go into, and a lot of this came out of the final regulations and some of its proposed regulations, things that help to define this. We're going to talk about the brand new, it's a brand new terminology they came up with, rental real estate enterprise, including the new safe harbor rules, and we're definitely going to get into the specified service, trade, or business question. So this is our topic for today. We're going to dive right into that. A little bit of background for you as we say, okay, where did this all come from? If you aren't familiar with this yet, and it may be that you've already heard little tidbits about it, it came about in December of 2017 with the Tax Cut and Jobs Act. We are focusing on just one little tiny section of that, known as Section 199A, or the brand new small business deduction. Even more specifically, we're diving only into one little section of that, which deals with what is a trade or business, talking about the real estate aspect and the safe harbor rules, and what a specified service, trade, or business is. So we're going to be giving a lot more detail because we're focusing in laser focus in those particular areas. The little bit of a disclaimer for you, this is very new law. All of this surrounding the Tax Cut and Jobs Act is going to continue to evolve in the future as we see the release of, believe it or not, additional regulations even beyond what we have seen. I'm going to try to point out areas that we've seen defined by 184 pages of proposed regs that were in August, and then refined by the final regs in January, and then immediately, not even a couple weeks later, already corrected for those final regulations. The new Notice 2019-07, which is regarding the safe harbor rules for real estate. And just know that this is going to continue to evolve as more time goes on. So this isn't that it's hard, fast, set in stone, but the nice thing is they finally have given us some good guidance with these final regulations. So that's at least exciting to see at this point. The basic idea of this, just in a really high level, the QBI idea, that means qualified business income idea, this deduction is equal to 20% of qualified business income from a pass-through entity, which sounds easy on the surface, right? Just to let you know that this course isn't designed to explain these calculations, and if in any way you're fuzzy in that area, there is a whole nother course we've created that is an overview of the basics that works on the calculations. So don't worry that you have to stop right now. You can go ahead and understand in depth the definitions of business and specified service, trade, or business, but then I recommend you take that other one that talks about the calculations. And additionally, I'm going to reference the final regs as they apply just to this course, but if you're interested in how the final regs affect other areas of this deduction, we also have come up with that course as well. So I recommend you take the final regulations update course. So that way we've kind of defined what we're covering just for the course of this next hour, and we're going to dive right into that. So first and foremost, we have to kind of dive into this idea of what a qualified trade or business is for the purposes, just for the purposes of this deduction or just for this code section. So if we look at what a trade or business is, as far as a qualified trade or business for this deduction, it's a specified service, trade, or business is any, let me just try to make that a little more clear. A qualified business or trade is anything other than a specified service, trade, or business. And we're going to define that later. Don't worry too much about that yet. This is at least a high-level term for the qualified business income, or I see it referenced as QBID 2, qualified business income deduction. It also says it's anything other than performing services as an employee, that basically you are not a trade or business if you're performing services as an employee. Now, to make it a little trickier, the term trade or business, this is not defined anywhere by statute or regulations. It is solely a facts and circumstances test instead. So how do we go about trying to define this a little further? In this code section 199A, which we're focusing in for this deduction, it just goes ahead and generically defines it by referencing code section 162. Now, before, when they came out with the law or even the proposed regulations, it really wasn't super defined. The final regulations luckily retained, and they slightly rewarded this so that now we have something to go off of. Basically, and this what this references here is the final regulations, it defines trade or business as a trade or business that rises to the level of section 162, other than, again, performing services as an employee. So, again, kind of feels a little bit vague, doesn't it? What is a business that rises to level of 162? So specifically, the little sections I've taken out of this, they say whether an activity rises to the level of 162 is inherently a factual question. And under the regulations, they determined that they weren't going to give specific guidance because that's beyond the scope of the regulations. So before you get nervous, we have to say, okay, what does this all really mean? Basically, know the old law and you're going to be okay. Under the old law, when we look at a trade or business, generally, the following things are required. Well, the business needs to have a profit motive. They need to be engaging in continuous and regular activity, and that activity has to have already begun, and they're selling some sort of goods and services. So basically, what we already know, our old law, our old comfort feeling of whether, we're going to determine that somebody's in a business, that still applies. That's basically what they're trying to describe when they say it rises to the level of section 162, that they are, for all intents and purposes, acting and behaving like a business. So yes, it is true that it is a facts and circumstances test, that they have, that they can't really provide a whole lot of specific guidance in that because it's part of old law or old commonplace knowledge that we have, but that's at least comforting. They aren't redefining that. They aren't changing it. It is, okay, we are comfortable with knowing what a trade or business is. At the same time, we have to kind of look and say, well, okay, hold on a second. This was in the way that the regulations work is they do propose regulations, and then there's an opportunity to comment on them, and there's public hearings. So some people were issuing comments like, okay, wait a second, what about the section 469 passive activity rules? What their answer was to that is, hold on, section 469, the purpose of that's your passive activity loss rules. Well, that's only designed to limit the deduction of certain losses. That's a whole different purpose. Section 199A is a deduction instead, so therefore, we're not going to use those rules. What does that really mean? What does that translate to us? A taxpayer does not have to materially participate in the trade or business in order to qualify. I mean, great news for us. There is no requirement for following the material participation rules like the passive activity rules are, because that is a limitation to a loss, and we're talking about a deduction instead, so different rules. Some particular possible issues in this area, well, it goes back to, again, old law or old knowledge. If we had a business that was intermittent or an unusual activity, definitely our hobbies. I mean, that is an area that's always been a tough area to call legitimately a business. And there's some worries about triple net leases or vacant land, and some of that I'll cover later on in the course as well. So, yeah, so we have to just look at it from that. We can say, know your old law, know your old rules, and apply them. There is also, if you're interested, publication 535. Under section 12 of that publication, they also list some information about the QBI deduction. So, yeah, this is from a publication, and sometimes that isn't as maybe in-depth as if we go back to the actual law or proposed or final regulations, but there's just some different resources out there for it. The main thing that they really kind of said over and over is consistency. The final regs definitely spell this out. They're interested in consistency. So if you're treating it as a trade or business, that you can't just kind of flip-flop back and forth from year to year, you've got to be consistent with it. Not only that, but they said, okay, if you really are a trade and business and that's how you want to behave, then you need to also comply with Form 1099 requirements under Section 6041, that we're not going to let you get away with that either. So consistency is kind of the bottom line in this case is, are we really behaving like a business? So the main starting point of this, just to kind of set you a little bit at ease, if you're comfortable with the old law and you know what a trade or business is, well, you're just already in a good spot because the final regs go along with that idea. And it isn't that it's really stepping outside of that zone, except, I mean, they did come down into clarification and saying passive activity rules aren't a worry. Well, that's really good news in this case because somebody doesn't have to have material participation and yet they still qualify for the deduction.